Hello and welcome. We're going to take a quick look at what happened at the Federal Reserve meeting in October, where we saw a cut in interest rates for the US economy by 25 basis points. Now, the first thing to say is this was again a split vote between FOMC members. So two dissenting voices, Rosengren and George, signalling that the FOMC is far from unanimous in terms of its view on more accommodative monetary policy for the US economy. There's a lot of conflicting data out there. And we'll just review that going forward, particularly for investors looking at what might happen at this crucial FOMC meeting in December. Will the Fed cut interest rates for the fourth time this year, entirely reversing their monetary policy tightening of 2018? Or, as we perhaps saw in the statement, the monetary policy statement that came out from the October meeting, will they sit on their hands for a few more quarters and trying to assess the incoming economic data? Well, the first thing to note is that inflation in the US economy continues by almost all measures to run below the Fed's target of 2%. And therefore, for people worried on the FOMC about potential for deflationary conditions to set in, there is certainly a case for further easing. And added to that, of course, is the weakness in global manufacturing, of which the US economy is not immune. The trade war between the US and China, but also more bilateral trade conflicts, do mean that US manufacturers, US households are paying higher prices for inputs, and that is taking their confidence levels down and their activity levels down. By contrast, and this is for the hawks on the FOMC, underlying services economy activity, underlying labour market activity, still quite robust. And we saw Q3 growth come in for the US economy at 1.9% annualized, 2% year on year. While not the kind of levels the White House want to see, this is clearly not a dramatic slowdown in US economic growth and not necessarily the backdrop to a Fed doing a sustained easing pattern. The final thing I think to mention, of course, is the political pressure that will come on the FOMC later in Q4, but heading into 2020 from the White House. Quite outspoken regarding the chairmanship of Jerome Powell and the FOMC, looking for further cuts to interest rates, but also signaling from the White House there might be a tax cut in the offing if they can get it through Congress. Now, this is something that the Federal Reserve are going to have to take into account if they think the further fiscal stimulus will be pushed into the US economy. That, of course, may have the perverse impact, the one that the president would want, which is for further cuts to interest rates. It may justify more caution on cutting interest rates further in the US economy. So the political cycle is absolutely key. And also looking at US politics, you have to take into account the fact that advertising, cyclical activity during the Democrat primaries, the kickoff in January of 2020, are macro significant for discretionary spending, advertising spending in the US economy. And we expect that, alongside the recent loosening in financial conditions, alongside the fiscal loosening, to mean that the US economy won't need looser monetary policy in 2020, so we anticipate a period of fair stability in the US interest rate outlook for over the next couple of quarters.